Overcoming an economic crisis in a country requires a multifaceted approach that addresses immediate stabilization while laying the groundwork for long-term recovery. Here's a structured strategy. Immediate stabilization measures: fiscal policy interventions, targeted stimulus, increase public spending on infrastructure, healthcare, and social programs to boost demand and create jobs. Prioritize projects with high employment potential. Temporary tax relief. Implement tax cuts or deferrals for low, middle-income households and SMEs to stimulate spending and business activity. Monetary policy adjustments. Interest rate management *. Lower rates to encourage borrowing and investment if inflation is low. If inflation is high, use calibrated hikes to stabilize prices. Liquidity support. Provide emergency liquidity to banks and critical sectors to prevent systemic collapse, e.g., central bank asset purchases or loan guarantees. Social safety nets. Expand unemployment benefits, food subsidies, and healthcare access to protect vulnerable populations and maintain consumer demand. Debt and financial sector management. Debt restructuring. Negotiate with creditors to extend maturities, reduce interest rates, or write off unsustainable debt. Avoid default through proactive engagement. Banking sector reforms. Recapitalize banks, strengthen regulations, and address non-performing loans to restore confidence in financial systems. Structural reforms for long-term growth. Labor market flexibility. Reform hiring, firing laws and invest in retraining programs to align skills with emerging industries. Anti-corruption and governance. Strengthen institutions, enhance transparency, and streamline bureaucracy to attract investment. Economic diversification. Invest in technology, renewable energy, and high-value sectors to reduce dependency on volatile industries, e.g., commodities. International collaboration. Seek IMF, World Bank support. Secure conditional loans for liquidity, while negotiating terms to minimize austerity impacts. Regional partnerships. Leverage trade agreements and regional blocs to open markets and boost exports. Foster innovation and entrepreneurship. Support SMEs. Provide grants, low-interest loans, and tax incentives to small businesses and startups. Digital transformation. Promote tech adoption and digital infrastructure to enhance productivity and global competitiveness. Political and social cohesion. Build public trust. Communicate policies transparently and involve stakeholders in decision-making to ensure buy-in. Address inequality. Implement progressive taxation and wealth redistribution measures to reduce social tensions. Adaptive and context-specific strategies. Tailored solutions. Address root causes, e.g., hyperinflation versus debt crises, with targeted tools like currency controls or export incentives. Phased implementation. Combine short-term stimulus with gradual fiscal consolidation to avoid austerity shocks. Examples of success: Sweden, 1990s, nationalized bad banks, ensured fiscal discipline, and prioritized transparency. South Korea, 1997, restructured chaebols, invested in innovation, and expanded social safety nets. Key considerations: balance conflicting policies, use stimulus cautiously in debt crises, pair monetary tightening with social protections during inflation. Avoid pitfalls, prevent excessive austerity, corruption, and policy inconsistency through rigorous oversight and adaptive frameworks. By integrating these steps, a country can navigate crisis recovery while building resilience against future shocks. flexibility, stakeholder collaboration, and a focus on equity are critical to sustainable success.